You're about to hear my conversation with Haiji Chen, Vice President, Portfolio Manager, Global Quantitative Equity Team at Mackenzie Investments. Today, we'll explore unpacking ETFs, strategies for navigating volatile markets. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast for Mackenzie Investments. I am your co-host, Prerna Matthews, VP of ETF Product Strategy. Today, we're diving into the world of ETFs and focusing on how they can be used to address the challenges of today's market. The topic, unpacking ETFs, strategies for navigating volatile markets. We'll learn more about the role that quantitative investing can play in volatile markets and strategies for advisors and investors to navigate such markets. Joining me today is Haiji Chen, Vice President and Portfolio Manager on Mackenzie's Global Quantitative Equity Team. Haiji is an expert in quantitative and factor investing and will share his perspective on market volatility, how Mackenzie's low-vol ETFs are constructed, as well as how they can be integrated into a portfolio to address specific challenges. Let's get started. Haiji, thank you for joining the podcast today.
Thank you for having me, Prerna.
Well, let's not waste any time and dive right into what we see in our headlines on a regular basis, what we're seeing in the markets today. How would you describe the current state of market volatility and what key factors are driving that today?
So, market has been relatively calm since the U.S. election in last November, because that was the biggest uncertainty the market faced, and that has been settled. And now the peaceful transfer of power happened. So the market has been relatively calm, and the market volatility has been lower than its historical long-term average. That being said, the market is still facing a lot of uncertainties today. One of which is a key driver of today's market risk, is the concentration risk. Because the Magnificent Seven, those tech companies, the top 10 biggest constituents of S&P 500, accounts for more than a third of the total market cap for the index. And that has been unprecedented in history. And that number has gone up more than 100% in the last 20 years. So that poses as a significant risk to the market. As a matter of fact, while we are speaking now, today market is facing a correction due to the correction of those tech companies. And there's news on the Chinese AI breakthrough, the DeepSeek, leading to those tech companies on track to losing $1 trillion of their market cap.
Yeah, that's a great perspective on what we've seen over the past few weeks and months. So in that context, and as you've stated, just riding the market can be great in the good times, but quite painful in moments like this. So for those unfamiliar with quantitative or factor investing, how would you explain its role in perhaps navigating days like today or moments that we will certainly see in the coming weeks and months?
Quantitative investing, or often called factor investing, to put it in layman's term, it's really just to invest stocks according to certain characteristics of a company. For example, when we talk about momentum investing, the momentum being a factor, it's really about buying stocks at high momentum. That the biggest advantage of quant investing or factor investing, especially in a volatile market, is its discipline, because it's a rule-based and you're investing according to a certain rules, and that helps you to avoid human biases. And as you can see, human investors tend to have, panic during heightened market volatilities, and oftentimes react at the wrong time. And quantitative investing through rule-based investing avoid those kind of pitfalls.
Great. So you mentioned a few types of approaches within quantitative or factor investing. Let's maybe focus on one of those in particular. We're talking about volatility so far. So let's focus on low volatility. What distinguishes low volatility as a strategy from other factors or other equity strategies generally? And how can that potentially be useful, we'll call it, in the environment that we may be seeing in the coming weeks and months?
So low vol investing really focuses on the low vol factor, or in other words, it try to look for stocks that has lower risk than the market on average, and that as a result, the constructed portfolio tend to have a lower volatility than the market. This can be helpful when the market is facing a lot of uncertainties. And oftentimes, when market is having significant drawdowns, low vol portfolios tend to have a lot smaller drawdown than the market.
So that's great, Haiji. You've given us a few examples of different factors or quantitative approaches that investors can take. Let's focus on one of those. Let's focus on low volatility as a factor, just given market conditions of what we've just talked about. So, are all low volatility factor ETFs or strategies built the same?
They are not. Well, typically, low vol products in the markets are based on low vol alone. So it's either by picking the lowest risk stocks in the market or construct a portfolio with the lowest predicted risk. Now, we at Mackenzie take a different and a more holistic approach. While we aim to still construct a low vol portfolio, we also incorporate three main investment styles in stock picking and aim to deliver excess return in most, if not all, market environments. We are also taking a nimble approach by trading our portfolio daily. This is in contrast to most of the low vol products out there being relatively passive. So we do all of it with a moderate total turnover to keep the transaction costs in check. But having a daily rebalancing of the portfolio, this allows us to take advantage of the newest information that comes into the market every single day. This way, we get to benefit from both a nimble and latest information from the market and a moderate transaction cost. Our low vol strategy, since it's been alive, has delivered more than 3% excess return in the last 4 years, while delivering a total volatility as low as the benchmark index, which is MSCI Low Vol Index. This is significantly lower risk than the core market index.
That's great, Haji. I just want to play back what I've heard. So, most low volatility strategies in the marketplace typically pick just the low vol factor. You're ranking your stocks and you're picking your lowest vol stocks and putting them in a fund. Whereas our approach is more holistic. So, you're looking at other key characteristics like value, growth, and quality, and ultimately trying to drive some excess return off of the min vol index. That coupled with, as you said, the turnover, so moderate turnover, so ensuring an eye is kept on transaction costs certainly, but trading daily to take advantage of what's happening in the market. So it's this combination of both a rules-based approach, but also being incredibly nimble, as you say, with information coming live on a daily basis. So really insightful and I think important for listeners to differentiate between everything that has the same title or the name, the low volatility strategy, but under the hood, the functioning might be quite different, as you say. So we've talked a little bit about the construction of these strategies. Let's turn our attention then to our listeners, to our advisors and investors who are looking at how to manage portfolios in the current environment, what we could expect. How can advisors think about integrating low volatility as a strategy into their portfolios? Are there specific use cases or scenarios where these strategies are most appropriate or shine best?
I think the low vol ETF or the low vol strategy can be a good complement to the core allocation, because oftentimes when you combine the low vol products with the core products, core index, what you're going to get is a better risk return trade off. What you're going to get is a better risk-adjusted return for the overall portfolio.
So as you say, Haiji, low volatility can be seen as core. It doesn't necessarily have to be a complement per se in portfolios. It can be used as part of the core as well, particularly as you say for advisors, investors who are sensitive to that risk, perhaps who have short-term needs to draw down on income, cannot take that short-term market volatility in particular, and kind of want that smoother ride. So, really great perspective there, and what let's talk about the longer time horizon. I've just mentioned short term, but over the long term, what kind of performance can investors expect from low volatility strategies during periods of heightened market stress, but also periods of stability? How have low volatility strategies generally performed over the long term?
So over the very long term, the low vol strategies tend to deliver very similar return, very similar long-term average return to the core index or core products. However, what happens is that when you invest in low vol portfolio, it tends to outperform during periods of heightened market stress. And when the market rallies, it gets to capture part of that upside from a bullish market. So in other words, you're going to have a lot smoother ride if you invest in the low vol product. Now, to give you an example, first half of 2022, the world market took a 19% correction. That's the MSCI World Core Index. Our low vol strategy live during the time was down only 9%. So in other words, the 19% total drawdown was cut by more than half. And over the last 4 years, 2021 to 2024, where our low vol strategy was live, it was overall a very bullish market. The MSCI World Index was up more than 40% per year. This is significantly higher than the long-term average return of the World Index. And our low vol strategy during the same times was up about 12% per year. So as you can see, in the bullish market, the low vol strategy, the low vol products can capture most, if not all, of the market upside. However, when you have a significant drawdown correction in the market, you're going to experience a much smoother ride. You're going to experience a much less drawdown during those volatile times.
Yeah, that can certainly be quite useful in advisor conversations, again, particularly with clients that have more jitteriness around the headlines in the news, just are uncomfortable with all of the uncertainty around us. Low volatility strategies can perhaps play an even greater role, as you say, in those situations. Okay, so let's turn our attention now to the long term. I mean, you've seen as a quant expert over the past many years, you've seen a lot of change in quant investing. I mean, we talked earlier about the daily trading. I believe your team looks at something like 20,000 stocks a day, and your model is accounting for more and more types of data inputs and factors. What trends or developments in quantitative investing and maybe even low volatility strategies do you think are ahead that investors should be aware of, or that you as a portfolio manager are thinking about?
Over the last decade or so, the quant investing has become a lot more core focused. By core focus, what I meant is that, in the past, if you go back 10 years, quant investors are oftentimes very close to value managers. They use a lot of valuation factors in their process. Now, today, quant investors are still value factors are still a significant part of the quant investing. So it's a significant part of our quant process and Mackenzie. But overall, quant investor has become a lot more balanced. They have utilized a lot more growth and quality and alternative factors to deliver a more consistent excess return for the investors. So this is what investors are after. They're not just happy with a long-term excess return, but rather they want consistent excess return. And that is what we here at Mackenzie are focusing at we want to give our investors a smoother ride. We want to give our investors a consistent exit return in different market environments. As for low vol investing, I think it's also the case that the investors has realized focusing on the low vol factor by itself is just not enough. Because if you just invest in the low vol MSCI low vol index, for example, which is pure low vol investing, you tend to do reasonably well over the long run. But in a bullish market, like let me go back to the last 4 years, an example, the MSCI low vol index underperformed the MSCI World Index, of the core index, by about 5% per year, where the core index was up 14% a year. The low vol index was up only 9% a year. So that is what if you just invest in the low vol factor by itself, what you will get. However, by being more balanced and holistic, like what we do, we deliver the volatility that is very similar to the low vol index, while we also delivered a 3% excess return in the last 4 years, making the total return of the strategy very close to the core market index in a very bullish 4 years. So that's what I think that the general trend for the low vol investing and for the quant investing.
Haiji, thank you for sharing your insights on navigating volatility and the role of low volatility ETFs in today's markets. We've learned some fascinating things about market volatility generally, but certainly about low volatility strategies, about the low volatility factor, as well as Mackenzie's approach in being more holistic and looking at value, growth, and quality factors. We've talked a little bit about the long term as well, and the smoother ride potentially that investors could experience in low volatility strategies. It's been fascinating to unpack these strategies and explore how investors can use them to build more resilient portfolios. That brings us to the end of this episode of The Invested. Thank you to our listeners for tuning in. We hope this episode has provided you with valuable insights. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our blog or through LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.